Well, after a 24% rally in the S&P futures, a little bit more in the Nasdaq futures, the trends that have been placed since the early April lows have now broken, and we're seeing momentum accelerating a little bit to the downside. The question is where is the level that people will be looking to buy the dip? What does that look like? And of course, the bond market very much screaming out. That is the signal that the equity market's looking at. We've seen the 10-year trading into 4.6%. The ultra long end, the 30-year Treasuries, trading out the highest level since 2023, well above 5%. Will the Federal Reserve come into the market or say something about this? Certainly, we expect J-Pow and Scott Bessent to do something similar. Now, in this situation, the word term premium is coming up liberally. People are getting familiar with that word. Equity traders are certainly looking at that very, very closely. And we're seeing the US dollar looking heavy as a consequence. We're seeing the gold price trade and looking like it might want to push into all-time highs. Talking about all-time highs, we've got Bitcoin trading there at the moment. There's a lot going on in financial markets. We're still thinking about tariffs. We're still looking at geopolitics. We're looking at earnings ahead of Nvidia. But what will happen with these equity markets and the dollar? That's what we discuss in today's trade-off. Hi, my name's Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics, and we're going to be discussing all the factors that are going on in this world of financial markets, and change may well be upon us. Mr. Blake Morrow, the term premium whisperer, let's come into the program, my good sir. Right, so we are seeing a situation here. We're going to discuss it all in a second in Topical Thunder. But yeah, I think the equity market, it was looking fatigued, nauseated, lethargic, tired, whatever word you want to use. We'd had a big run. We hadn't really seen too many in the ways of drawdown in really since late April or going into the sort of meat end of April. And people now are looking at term premium. They're looking at deficit levels, and maybe this is the smoking gun that just needed to happen. So at a high level now, Blake, before we go into the inner workings, was this the sell-off that really needed to happen, or is this something more sinister?
I think it's something more sinister, and I'm not. Yeah, here. Look, Chris, you and I have been around for a long time. Too long, probably. And we've traded pretty much every environment. And the one thing that I've realized over the years is bear market rallies are pretty convincing.
This isn't a bear market rally, man. Come on.
This is a bear market rally. This is a bear market rally. We're going to create lower highs.
It's going to be the biggest bear market rally of all time, is it?
It has been epic, and it's one that's so convincing, Chris, that people are all and were up until today looking at all-time highs. But look, the market's got some things stacked against it, and I'm not saying that we're going down to 2,000 on the S&P either. I'm not in the crash mode. I do believe we're going sideways for many, many years, and I think you got to use these rallies to sell into, free up some cash, buying on dips. And you asked the perfect question, Chris, where do we buy the dip? And I think that's something that I'd like to tackle today when we talk about, the broad markets.
Yeah, buy the dip. Give me a level. Give me a limit. Give me a limit. Don't just say, but you can never be wrong if you just say buy the dip, because eventually the market will dip. And it was, the way I like to look at it is actually, don't buy the dip, buy the rip after the dip. That's the way I like to get a bit more confirmation in the market. Anyway, let's go into Topical Thunder and discuss. Right, let's go into US Treasuries because they are the talk of the day. We call that talk du jour. And what we're seeing now is a buyer's strike coming through in the Treasury market. Now, of course, we did get the downgrade from Moody's on Friday. I think it sort of told us what everyone knew, and that is that the fiscal position in the US is precarious. And, with the lower revenues that we're going to be seeing through the tariffs, they may change. We could talk about that in a second. But with Trump trying to pass through a reconciliation bill, and actually, Blake, we're just seeing a situation now where the SALT deductions are now being pushed up to 40,000, which is going to make the situation even worse. They're going to cut the senators are going to cut back on reduced Medicaid spend. So that's just going to perpetuate the deficit. I mean, I think what was interesting in the Moody's downgrade was that they're modelling deficit levels in the next decade. It's a long way away, but deficit levels of 9% of GDP. So I think that just tells you the path the US is on, and obviously the way that bond yields are trading now, that the interest expense that's going to be coming through from the Treasury Department is just increasing every day. Now, of course, the US Treasury Department, the US government are not going to default. That's just not going to happen. But they can just print money. So there's this idea about buying CDS because the US could default. It's nonsense. But anyway, what the bigger issue is people aren't buying because people are looking at the deficit issues. We're passing this deduction now. We're getting less fiscal revenue from tariffs. That may well change. But what we're seeing now is, as a result, is that as we go into Q3, as we look ahead to Q3, when we're going to get the next Treasury refunding, what date's that going to be? 30th of July is going to be the next Treasury refunding. Will they announce that later on, probably 2026, or give a strong indication that there will be higher coupon issuance and supply coming through? And what we're seeing now is, of course, you've got the 10-year pushing 460, which has been a level where people were buying recently, and then you've got the ultra long end, the 30-year coming, closing nicely above 5%. But we're also seeing inflation expectations moving up. You've got 1-year swap rates moving up to 345. Longer end's pretty well anchored, but inflation's moving up. Expectations of future issuance are increasing. And the word term premium is the one that everyone needs to be focused on now. That's trading at 79 basis points. Term premium is not good for equity markets. What that is essentially, if you've got if you're an investor and you want to go out and you can go out and buy short-term debt, like a 1-year US Treasury bill, for example, and then you can just roll that over for 10 years. Now, if I went out and go and buy 10-year Treasuries, why wouldn't I just go out and roll over that 1 year? And essentially the difference there is the insurance or the compensation that I have for buying a longer dated paper rather than just rolling over a short-term paper. And that's increasing. That insurance is increasing, or that compensation is increasing. And that term premium is now weighing on the US dollar. It's now going to become noticeable by equity markets, and it's pushing up the long end. It's taking that long end higher yield than the short end. And I think that's really what everyone's focused on. So, what are you looking at this Treasury market? Was just this the smoking gun that the equity market needed, just an excuse to take some profits here, Blake?
Well, first of all, where's my century bond? I've been wanting a century bond. Please issue one of those in my lifetime. I wonder if we're gonna be getting that. But no, this is not just a U.S. issue, though. Look at what happened in Japan just 2 nights ago.
The 30-year JGB is trading. It's ridiculous. I mean, I was just trying to interject. Sorry, I've taken up a lot of time.
Oh,
but
please.
We saw the 20-year US Treasury auction coming through in your daytime. I don't know how many people look at, but want to pile into 20-year Treasuries. It's not one. Next week we've got much more one that you need to look at, which is going to be the 2s, 5s, and 7-year Treasuries. So we're watching the demand there and how that tails. But in Japan as well, they had a 20-year JGB auction a couple of days ago, and that was awful. So again, there's a buyer's strike taking place in the bond market, especially towards the long end of the curve. And with a lack of buyers and sellers, you're just seeing yields moving higher. And of course, for equity markets, this does matter because, theoretically, when we go to university and we study finance, applied finance, whatever, we're told that we get the cash flows of these companies, we discount those cash flows to the present value, and we use a hurdle rate effectively, which we can use the risk-free rate, the 10-year Treasury. And as the yield goes up, effectively that net present value on those investments is falling. That happens for business as well as for equities. And so it does matter. It matters for the real economy because credit's priced off the 10-year, mortgages are priced off 30 years. So higher yields, obviously higher borrowing costs. We have lower net present value on investments. And that's why this does matter. And term premium is the evil behind this, right?
And it is. And it's like I know we need to move along, but it is a global phenomenon to take a look at yields. Just, whether you're looking at boons, gilts, JGBs, whatever, you look at them today and yields are up across the board almost on every issuance. So, but yeah, Chris, that's, I'm going to go to the next subject. And that's when we start talking about markets. And this is when the market goes, oh my God, we're yelling fire in a theater with 2 exits in the back and the theater is full. But should we be? And that's the question that I'm going to ask today. Is you've seen obviously the response in the equity markets. Technically, we're going to talk about what it looks like and the risks that are now associated with the markets. But we are seeing some broad-based selling. Well, I say broad-based selling. I say broad-based as far as the U.S. equity markets go. It's to be seen how the rest of the world's going to be responding today, especially when you're talking about the Nikkei tonight or for your day, and then later on for you, how the European markets are gonna look, especially when you have like stocks like the German DAX that's closing at all-time highs. as well. But how do you think that the bond market is impacting the other markets? Because you said it does matter. You mentioned that as soon as you start talking about the treasuries. But is it something that we as global investors should be worried about what's happening in fixed income?
Well, absolutely. I mean, you do see a situation in treasuries rise, and the Aussie government bond market sells off, and you see it, and they do tend to move up in unison, and you do get spread widening and spread differential. But I think that makes it's an issue where you've got very very high government debt in certain countries. Certainly, Japan takes the absolute biscuit there, and of course that's what's happening in the US. We are seeing a situation in the US where some people are saying, is this the next Liz Truss moment? I'm not so sure about that one, but that's where we are. People are concerned about rising deficits and the sustainability, and effectively where this ends. I mean, it's the government's. I think the last time people really campaigned on deficits was in the Clinton era, where they actually it was a major voter issue, but it's not anymore. People want growth now. If that means higher deficits, so be it. We want growth now. We want jobs now. Fine, we can pass that shit on to our kids back on, in 20 years' time. I don't care. It doesn't matter now. I want growth right here, right now. And if you try and change that dynamic, by austerity and lower spending and higher revenues, you'll lose the next election. They've got midterms coming up in November, and that's a big thing. So, but I think really what we're starting to see is people centering on those countries which do have a deficit issue. So we are looking at the US as a predominant, and I think that's why you probably are seeing capital flowing into Europe. Euro dollar's pushing higher. Australia's got very low government debt as a percentage of GDP. So we're probably going to see that market outperform, and China's in a similar situation. Massive public debt, but government debt as a percentage of GDP actually pretty low. So I think you might see China and the Hang Seng outperform. So I think that's where we are. We are looking at that. And the interesting thing here, Blake, of course, is that rising yields, long end yields, is usually pretty good for the US dollar. But we're not seeing that. We're seeing a complete opposite now. We're seeing high yields, higher, steeper curves transcend into a lower US dollar. And I think part of that's because high yields. It depends what's driving that. If it's better growth, better that situation, and rates are being repriced, and rate cuts are coming out because of better growth dynamics, then of course that's a US dollar positive. But what we're seeing here is term premium rising, inflation expectations rising, and growth dynamics falling. I think second half we are going to see much slower growth. A lot of the growth we're seeing in the US has been brought forward. You've seen companies bringing through inventories. A lot of the tariff stuff's going to manifest in the second half. So we are talking about a stagflationary environment, and that is negative for the US dollar, despite the higher yields, right?
And negative for equities too. So let's not forget that there's a couple things that go hand in hand there. And what you're mapping out, Chris, is something that such an important dynamic. It's with when yields are going up, when there is growth associated with that. That is where it reflects in the dollar. The dollar tends to rally. And right now you're seeing the opposite. And there is going to be a point, if things continue, there will be a point where the dollar will probably, take the mantle again as the risk off type of currency or safe haven type of trade. But that's not today.
I think when we start talking about the Fed having to roll out swap lines and bits and pieces, and we see dollar funding issues playing through, that's when it becomes, I am the global currency, the reserve currency, and that's where it says I'm the Mac Daddy of safe havens there. But I think in that time, right now we're trading relative growth and all those factors. And I've got my eye on short-term swap rates. They are moving up, so inflation expectations are moving higher. And I really do believe that the second half is going to see slower growth. Second quarter, this quarter again, is growth is looking pretty good. We're sort of tracking around 2.3%. But I think things will get a little bit more dicey as we go into the second half. And as I say, what we've been seeing, just even the simple math of the situation, is these companies are they've been front running the tariff effect by bringing inventories now. Just the simple maths, if you look at it on a base effect, means that we are going to see slower growth in the second half. Now, if we see slower consumption patterns, that leads us. Whether that leads to a spike in unemployment is obviously yet to be seen. But I do think we're going to see, generally slower growth just because of those base effects. And I think that's a really big dynamic to play through. Now, one of the factors I also want to talk about is this idea. We can talk and sort of lead it into the US exceptionalism trade and whether the rest of the world is going to outperform the US. And people have been trying to do long short strategies on that. But of course, when we're talking about this, we've got to talk about Nvidia, because we can focus on all the bond market, and sometimes we do need to look at the bottom up picture. And there's really no company that affects the top down sentiment, the market sentiment from a bottom up perspective than Nvidia, right? Now, they come out with earnings after market on Wednesday, coming up next week, 4:20 your time, New York time. For us Aussies, it's going to be 6:20 in the morning, like 9:20 at night for those in the UK. And look, I mean, they've had a nice rebound. They were right at the centre of what we saw in the rebound in the S&P and the Nasdaq from those, I think, 7th or 9th of April lows. Really strong moves up now. And what we saw with Nvidia is we saw the diffusion ruling coming through. That's still yet to be superseded with a new ruling, but effectively that was a big box tick for investors. We saw the hyperscalers coming out, committing to capex, and of course Microsoft, very much at the centre of that. Really good numbers coming from Azure, and that sort of hyperscale concern has been a big tick for investors and pushed Nvidia's share price. Now it's the big one. It's the earnings that come through. Now they always beat, and they always upgrade their guidance for the next quarter. But will they meet the market this time? And that's what we're really concerned about. I think people do want to buy the stock, but they want to get this earnings out the way. And I think we could see the stock fall into those earnings. Now, the market is looking for about 43.3 billion in revenue. The two numbers you'll look at for Nvidia are revenue and gross margins. It is a gross margin story, and they're expected to come out of gross margins on the quarter of 71.07%. Will they beat that $43.3 billion? Now, will they guide for the next quarter? The market's expecting for the quarter ahead. These guys always give categoric and quantitative guidance, and the market's expecting $46.5 billion for Q2 for revenue and gross margins to improve to just over 72%. And so that's where it is. If we do see that the company beating by a modest amount, guiding to high gross margins of 72%, I think the stock could rip, and the market's expecting about a 7% move on earnings up or down. So, I think there's a big one. How much? I know you're like a big FX guy and you do look at some indices, but how much are you going to be looking at that Nvidia story after market on Wednesday?
Well, I'll be looking at it, and I'll be, really focused on what Jensen says during the press conference. He's Wall Street's golden boy right now, and he always says the right things and gets the market excited about, Nvidia and the current landscape. But he's going to be picked on pretty hard this time around. I think everybody's laser focused on what Nvidia is going to do. I need to point out that Nvidia has actually underperformed the S&P rally. So as the S&P general market has stretched towards, almost all-time highs once again, Nvidia has stopped short of even the 78% retracement, and it's been in a tight range over the last week. So it got hit today pretty hard, and it came to the lower end of its range. But I think you're so right on the money, Chris, that everybody's going to be focused on Nvidia next Wednesday. Is Wednesday after market close. So for those of you that have any type of risk on, risk off, quote unquote exposure, be very, very well aware as we go into Wednesday afternoon.
I just want to say one thing as well. But you might not be a single stock guy or girl, but if you're trading the Nasdaq futures or Nasdaq CFD or cash, the options market is implying a 7.4% move on the day of earnings, up or down, right? So if you look at the market cap, they've got $3.2 trillion. You look at the weight they've got on the Nasdaq. If it was to realise that the implied move 7.4%, that would equate to, all things being equal, no other stocks included and no other macro issues, a 0.5% move up or down in the Nasdaq. So that is, if you're trading on decent leverage, that's still a move that you want to be cognizant of. So even if you're trading the index, this is a risk for you.
Yeah, it's 100%. And that brings us to our last subject. I want to talk a little bit about assets because, what we've seen as of recently, and this goes back to something that we talked about at the end of this last year, Chris. You talked about the end of market, looking ahead into 2025. We discussed how, equities it's going to be a little bit challenging. We're going to see some rough waters, and it's going to be a stock pickers market. And right now, it's also becoming more of an asset pickers market. This is not a one size fits all market, depending on what asset you're trading. I mean, you look at Bitcoin, you're like, holy crap, Bitcoin just hit an all-time high and it closed at its highest levels over the last 2 days. I'm buying crypto. You can't do that. You can't buy just crypto. You can't just blanket buy crypto. Go look at Ethereum or Solana or something else. Go look at other crypto assets. They have underperformed. If you're trying to trade precious metals all the same, I know you're going to talk about a precious metal, so make sure you all stick around for that. But if you're looking at gold, it's not trading the same as silver. And then you go to FX. You look at the dollar and you go, wow, broad-based dollar index, it's doing this, that, and the other thing. That doesn't mean that the dollar is going to be acting the same way against every currency, especially if you're talking about Asian currencies, or you're talking about, the Anapodians, the Aussie or the Kiwi, or different commodity currencies. So this is where macro is playing a big factor into the markets. And this is where you have to be paying very close attention to the specific asset that you're trading, not as a broad-based trade. And I wanted to talk about that because I think people are so used to the market moving in one direction, so they know exactly what to do. And it's been that way for years. But things have changed. Times are changing. The market's changing. And this is the time that you as a trader need to be a little bit more informed. And that's why everybody should be watching the Pepperstone Trade-Off Show. Everybody should be sharing this show via social media. You see it on LinkedIn. You see it on Twitter. Do us a favor. Do your fellow traders a favor. Give us a retweet. Give us a follow. So anyway, I'm gonna get off my box here, Chris. But how do you feel? Hey, it's got to happen. We got to talk about this type of stuff. This is what makes markets, and this is what makes traders become real traders and become educated. So, Chris, how do you feel about the whole one size fits all? I just talked the whole.
I don't think I can add much more to this. I mean, correlations. The only thing I would suggest, right? You talk about all this diversification and asset level and all. The other thing you can do, of course, is strategy. We can talk about how strategy works. And I like to think of strategy from a volatility perspective. You've got strategies which are long volatility and short volatility. Like mean reversion, for example, is a short volatility strategy. It tends to do well when vols are low and markets are sort of trading sideways. And then you've got like long volatility or high volatility strategy, like trend following momentum that likes breakouts and then that's when you get correlations moving together when you get high volatility. But trend following, for example, typically looks for those outliers. And then so I think what you're doing is, you can look at relationships and correlations breaking down and looking at how that works from an asset perspective. But the other way you can look at this is from a strategy perspective as well. For me, I like to trade momentum. I've got trend following strategies. But also some mean reversion and some other sort of technical stuff. So it's really about what the market environment's doing and how that strategy is playing into the different market environment. Everything works optimally in different market environments. So the other one I just want to add there is that you can think about this at a strategy level, not just an asset level as well, Blake.
Good.
Yeah. All right, let's go to the technicals. Let's go to That's a Setup. Oi, oi, Savaloy. Let's go to platinum. Why are we not looking at gold, they say? Well, gold's looking pretty good as well. I think we'll probably go, we're not a million miles away from all-time highs, about sort of 5% now. I haven't got the gold chart up there, but we are pushing the 61.8% retracement of the recent decline. And it looks strong, the Chinese continue to buy. We just saw the import numbers coming out for April. We had the highest levels in 12 months, but that's a similar thematic in platinum. And we just saw the statistics coming through with imports of platinum, the highest levels, over a year. And the Chinese themselves, they're going for a bit of a renaissance. That's a French word, Blake. In everything precious metals at the moment. Shanghai is just absolutely exploding and interested in precious metals, mostly on the physical side. Through early April, we saw big ETF flows, not just in the GLD in the US, but also in some of the big Chinese ETFs. That's settled down a little bit more, but I expect that to kick up. It doesn't seem like the Chinese are particularly price sensitive. There have been big buyers with gold in the Shanghai futures at all-time highs or near all-time highs, similar on the COMEX. But platinum's the one that I'm looking at here, Blake, because it's just absolutely ripped. We've broken out to the top side, and breakouts happen all the time, but it's what that breakout looks like. And look at the breakout. I mean, it is a show of force. It is an intent. And yeah, pullbacks are probably a buying opportunity. I think the pullbacks will be fairly limited. Yes, an explosive move. Some of that heat needs to come out. But I think what we've seen there is a pretty big statement from the market, and so the Chinese are big buyers. We saw that in the import numbers. We're seeing that in the flows. I think this is one that you've got to have on your radar. Now, the middle indicator is one I actually set up myself in trading view. It basically just looks at the differential between the 3 and the 8-day exponential moving average. Stocks a 20-day moving average of that, and looks at 2 standard deviations either side. And you can see, really, it's just a momentum indicator, really. But it's just, you can see that, that's really blown up. And so with the rate of change at the bottom really moving up, if you're a momentum guy or girl, I think, this is an explosive move, needs to be on the radar.
That is, and I love the wind up, and then the explosion means that it's impulsive.
Yeah.
And yeah, you got to be following that one on the web. Well, I'm going to give you something on the way down, and let's talk about the dollar. And a couple of weeks back, Chris, we talked about a bear flag in the dollar, but it was a little bit shorter time frame. But really, if you look at it, you take a little step back. I think the dollar looks like it's going to get whacked. Now, again, this is not a one size fits all type of trade. Last week, we talked about the US dollar Norwegian krona. It is now making new trend lows because as the euro reversed, which we talked about last week, the US dollar Norwegian krona should have hit new trend lows. It did today. And you look at this bear flag pattern, it takes us all the way to sub 90. Now, I don't think that we're going to be doing that in one fell swoop. As I told our traders today, I'm like, unless there's some sort of Mar-a-Lago trade accord that just pops up, or maybe some trade deal between the US or the EU really kind of falls apart at the seams, we might see a more accelerated move. But I think this is going to be a fairly messy move over the remainder of this next year. That means we're going to be selling rallies in the dollar index, but that bear flag, it's got a long way to go, especially if we break below 97.80, which is the recent lows that we hit back in April. We hit new lows, and you just got to look to sell rallies. But the dollar index, I think, is a great setup for sell rallies, don't buy the dip, and just continue to.
Well, if you have a look at Korea
towards the
yesterday,
91.
I mean, we've seen overnight that my overnight that they pretty much confirmed that they are looking at the selling dollars in the market. The Korean won has rallied hard. But yeah, the good thing about you, Blake, you talk about selling rallies. Well, you'll give us some limits to sell into, and I know you'll give us some quantitative and explicit limits to do so. So I look forward to getting that rather than the sort of sell rallies. You never be wrong.
Okay, when it gets to 100, sell it. There you go.
There you go. Big number. All right, cool. But yeah, I mean, I think if you're going to get the dollar index down by the fact that the euro is 57% of the dollar index basket, that would imply that euro dollar is pushing 120.
Yes,
in that move.
120, 122. Yes.
You've got to be thinking in that situation that the ECB will be not overly happy by that. Trump will be pretty happy because your deficit levels are reduced because of the dollar weaker. But you've got to be thinking to yourself, if tariffs are going to be inflationary for the US, we're already seeing that. Nike just told us they're putting up prices. We've just seen, the retailers in the US telling us they're putting up prices.
Walmart,
other factors. So Walmart, Target. If it's going to be inflationary for them, for the US, that's you. It's going to be disinflationary for Europe. And if you add in a euro dollar at 120, well, the ECB are not going to be liking that in any kind of way. And at a government level, they're going to be fighting it as well. So it gets a bit spicy when euro dollar looks like it might be heading out to those levels with tariffs being disinflationary for Europe and for other countries as well. So something to think about. Anyway, I want to go to the yield curve, because this may not be something that everyone's jam. If you're relatively new to markets, you probably haven't got an absolute Scoobies what the yield curve is. But really, what we're looking here is the difference between the yields in the 2-year Treasury and the yield at the 10-year Treasury. Now, as you can see, as this is going up, what you're doing is the yield that you're getting on the 10-year Treasury is increasing at a faster rate than the front end. Now, as fixed income traders, what we've got to do is, if you're going to go and trade this, and curve steepeners are a really big deal for institutions who trade fixed income products. there is a duration mismatch between the two. The 10-year does trade at a faster clip. So when people, are looking to trade this, people will go and sell the 10-year and they'll buy the 2-year, but then they'll have to sort of duration match that to make sure it's done. But that is a big trade. And what people are doing now is they're seeing the yield on the long end, the 10-year Treasury, underperforming, so moving up faster than the 2-year. Now, what we can do is we can extrapolate this very loosely to say this is being driven by term premium. And that word term premium is something that you need to chat GPT, you need to Google it, because it is you speak to 20 different fixed income strategists, you'll get 19 different answers as to what it actually means and how it's. But essentially, as I say, if you're buying a 1-year Treasury, what's to stop me? I've got the choice of buying a 1-year Treasury and rolling it over at the end of maturity every year for 10 years, or buying a 10-year Treasury and committing to that paper as want to hold it to maturity. I'm locking in a 10-year Treasury. Why would I not just buy that 1-year Treasury and just roll it over? So what we're saying as 10-year Treasury investors is, what is the additional compensation for market risk, market liquidity, for inflation expectations, all this sort of stuff? And as that's going up, that what we call term premiums rising, it is pushing up the back end of the curve much more substantially. Now, that is a concern for the equity investors. So why are you looking at this chart? Well, the steeper it goes, effectively, the higher term premiums going, and the more negative we're going to see equity risk. So that's why I'm looking at this. What it is on TradingView is essentially the 10-year Treasury minus the 2-year. The higher this goes, it's essentially saying that the higher term premium is, the higher the risk in the system. And I think you'll probably see equity markets underperform the higher this goes.
Well, then the higher that goes, probably the lower my next setup goes, which is the Kiwi yen, which is very closely associated to risk. Now, this is a 4-hour chart. And Chris, we don't always use intraday charts, but in this case, we have a nice little head and shoulder pattern. We have a failed rally attempt when we hit that head, back in last week in May, or it was early last week. And now we have a head and shoulder pattern that actually points to the 618 retracement just below 83 yen. We've seen a little bit of shakeup in the yen as Bessent and his Japanese counterpart said that they discussed, currencies, and they said the market will set, the price of the yen and blah, 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 blah. So that kind of moved the dollar or the yen just a little bit. But I'm looking at this as a breakdown. Look, I'm going to give you a level, Chris. I'm going to give all of you guys a level. The neckline comes in at 85 yen, and a break and a sustained break below 85 yen will take us below 83 yen to complete the head and shoulder pattern. I never like to look for completions of these patterns, so I would be looking for about 83. You can overshoot that and get below it. That's fine by me. But if you can get a bulk of the trade, 200 pips of a 250 pip move, that's a pretty good move. And that should move down as term premium that Chris just noted continues to go up. All right.
Well,
so Chris,
they say, Blake, only real men sell Kiwi yen, buddy. Anyway, there we go. Let's go to the play of the day, play du jour. Sorry, I don't know if you caught that on camera.
You rocked out, man.
I got dollar Swiss. I'm going to go for dollar Swiss now. You and I talked about this before. It doesn't keep me up at night, Blake. It doesn't keep me up at night. Nothing does, to be honest. I'm one of the best sleepers out there. But there is a bit of concern about being long Swiss. I'm not concerned about the fact that the Swiss government will potentially go into negative rates. I think that's largely in the price. If you look at Swiss swaps now, they are discounting the Swiss government do go into negative rates again at some stage further down the line, throughout this year. What does concern me is actually them going into the FX market and trying to mitigate some of the strength if we were to see further strength coming through there, because they don't want this to impact and create accelerated disinflation. But what I look for in everything like this is what the broad market's saying. It doesn't matter what I think. It doesn't matter what you think, actually, Blake, to be honest, all due respect. It's what the collective think and what we think they're considering of doing. And what we're seeing from this aggregation of all those beliefs and all those views is this is breaking down, similar to what we're seeing in dollar yen, similar to what Blake just showed with the dollar index chart. But if you do take a view on a weaker dollar, it comes back to Blake's thesis that not all assets and not all dollars are going to be created equally. Not all assets are created equally. You've got to go and select certain things that's going to outperform. And I do think if we were to see, if this buy the dip doesn't kick in, and the level that I'm looking at, Blake, on buy the dip is on the S&P. I know you're just about to bring it up, and actually maybe I'll opine afterwards. But if this does actually manifest into something a little bit more sinister, yeah, the VIX pushes up into the high ends of 20%. FX vol, rates vol continues to build. If this does, Nvidia misses earnings, we go into, let's another one, 9th of July, we've got the 90-day pause deadline on reciprocal tariffs on all nations. The big one on the 14th of August is the deadline for China. Trump, with one sweep of his tweet, could effectively derail and cause a massive market move. Just one tweet, that's all it would take. But the Swiss would be one I'd be looking at. And right now, where does this go? Well, the market's telling me that the probability is towards further downside. Nothing's assured in trading. If you knew, you'd be insider trading. But when I look at that chart right now, I'm saying, where is the probability? Up, down, sideways. I'm saying right now, the probabilities are skewed towards downside, so therefore I'm short.
God, I love it when you talk probabilities, because I'm going to talk about it too in my setup, or my play of the day, which is going to be the S&P coming out of my favorite reversal pattern. They're either ascending or descending wedges. They're significant reversal patterns. That's when we break that lower trend line that we did today, which is now going to put, and it should put, the 200 DMA in play next, and below the 200 DMA, which is at 5,800, which is also the previous highs from the 24th, 25th of March. We break that, we're going to the 50 DMA, that shaded area, which is also near the 38% retracement of the entire move. Now, some of you could argue and say, well, a 38% retracement, it's not the end of the world. No, it's not. A move to 5,500 would be a good level to be buying the dip. Chris, you want to talk about buying the dip? 38% retracement comes in at 5,523 is by my Pepperstone S&P chart that I've got in front of my screen. So we get to 5,523. That looks like a good level to be buying the dip, but that coming out of an ascending wedge, that is the target area for the S&P downside. So if you think it's over, yeah.
I'll just a bit of background. Our S&P cash is effectively priced off the futures. Now, what we do is we take out the dividends and interest payments to create a synthetic cash price that mirrors the S. Because also you can't trade the S&P cash, right? You can do it through the SPY, but effectively the S&P cash is the valuation of all 500 companies. But you can trade the futures. We get that futures price, and you take the fair value out of the market to give us a cash price. Now, if you look at the real cash market, which, as I say, you can't trade, but if you look at the real cash market, on the 9th of May, we gapped up. And I think that's a really big level for me now. 56.91 was the close on 9th of May. So that would be where you fill the gap. So you can just about see it on our chart, just below that big blue candle. But that would be the level I'm looking at, 56.91. That would be where price comes down to fill the gap. Gaps there to be filled, as we know, Blake. But that would be the big level that I'm looking at. If we can get a little bit of a squeeze, do we get a runaway breakaway gap further down? Obviously, that'd be very powerful, and say continuation. All of the buyers step in, and so that's where I'm looking at. For me, where I buy the dip, it's a little bit lower than where we are at the moment. But if a bit more of a liquidation after this knackered market, comes in, 56.91 is the big level for me there.
Well, Chris, thanks for giving us those levels to be looking at to be buying that dip.
Wicked. All right, Blake, you've been a legend today. Thank you very much. Fired up. Good to speak. There's a lot going on in financial markets. The winds of change may be upon us. Maybe it's not. Is this the time to buy the dip, or could something a bit more sinister brew as we go into some of these deadlines? Maybe slower growth, higher inflation, and bond markets very much front and center. Thank you, everyone, for watching the show today. Pass it on, as Blake said. Let everyone know the love. And we'll see you back next week for more of The Trade-Off.